can be knocked back on that claim. Now, you can only claim GST to the extent to which it is deductible. That then brings us up to the next topic: what is deductible? There are heaps of things that are deductible, but there must be a nexus between this and your income earning activity. The starting point is to ask yourself the question: did I genuinely incur this cost in order to generate income? I am simplifying things at this point, and you cannot rely on that statement at all. There's heaps of case law where the tax office has actually said, well, I didn't really mean that. What I will do is address some of the more topical items that come up when we are dealing with Isagenix people. Some of these areas are targeted by the tax office this year, and there's been an dramatic increase in the number of incorrect claims. Self-development courses and seminars. There have been a significant increase in the number of individuals attending these types of courses and seminars. They cover such topics as motivation, stress management, personal planning, time management, leadership, mentoring staff, etc. Now, don't let that scare you, because you guys are actually in that industry. It's acceptable. Tax office takes the view that these courses will only be deductible to the extent to which the course or seminar is directly related to the taxpayer's current earning activity, as is the case here. The tax office asks the question: does the course enable the taxpayer to become more proficient in carrying out their income activities? And/or does the course objectively lead to, or is likely to lead to, an increase in the taxpayer's income from their working activities? That's a big yes for today, guys. Topics that the tax office consider private in nature and non-deductible include diet and nutrition, another case here, intimate relations, mediation and empowering emotions. Yes, I did say intimate relations, that is in tax documentation. Now, if you are attending a course which is directly related to your income earning activities, they will be deductible. So if you are a life coach and you are doing a course in life coaching, it is directly related to your income earning activities, so it is deductible. Simple, really. For more information, you should read the ATO fact sheet claiming self-education expenses self-development courses. These are available on the tax office website, www.ato.gov.au. I'm not saying certain deductions, courses are not deductible. I'm saying don't assume that all courses are. Travelling costs is a big one. What stems from this topic is overseas travel, as many of your courses are held overseas. If the course isn't deductible, the travel costs are not deductible. If the course is tax deductible, then the travel costs will be deductible. Most of the courses overseas that you would attend are all inclusive, but if you incur any costs, you should keep receipts, even if you get a double decaf at Starbucks. These receipts don't need to be in Australian dollars, but they need to be in English. Also, when you're travelling overseas or in Australia, if the trip is for 6 nights or more, you need a travel diary. The diary that records what you did while you were travelling. That doesn't mean you record, I got up, I swam in the pool, I had breakfast. On the business days, you record your business meetings, who they were with, and the topics discussed. On the days that are not business, you did not do any business work, so you just record private. There is no time limit as to how much time you need to have worked on that day to make it deductible. You just need to have done some work on that day, and the whole day is deductible. Generally, the itinerary from your seminar will be sufficient detail for the purposes of justifying your claim. So always retain copies of your itineraries. If the main purpose of the trip is business, then the airfare is fully deductible. If the main purpose is holiday, then the airfare is not deductible. If this is not clear, then the tax office will proportion the airfares. In regards to accommodation, meals and incidentals for those days that you are effectively working, they're deductible also. Those days that you are holidaying are not deductible. If you bring a spouse who is not there on work, then their costs are not deductible. They would need to keep a travel diary to substantiate this also if they are working. Children are not deductible, and good luck trying to convince me that they are. If your spouse comes with you and the cost of the hotel room does not change by the fact that you have an extra person, then the full cost is deductible. If the cost increases, then the net increase is not deductible. This is just a general idea of the rules, as it is very complex. In fact, a seminar I attended recently dedicated 40 pages to it. Motor vehicle expenses. This can be a big expense, and as such, the tax office can be pedantic when it comes to record keeping. If you are an individual or a partnership, there are 4 methods for claiming motor vehicle expenses if you do over 5,000 business kilometres a year. If you do under 5,000, there's 2 choices. How many choices are available to you depends on your record keeping. Keep a valid logbook and keep receipts for all of your expenses, and your accountant has the option to pick the one that works best for you. If you operate through a trust or a company, there are 2 options. These are different options, but again, it is wise to keep a logbook. Here you can either use the logbook method or what they call the statutory method. The statutory method deems a private use portion on the motor vehicle based on kilometres. That's total kilometres, not business kilometres. Based on this method, a car that has no business use can effectively get a 60% deduction. Write that one down. If you do the right thing, you can get deductions for your spouse and your children's cars as well. I'm thinking about packaging my dad's car. On the point of motor vehicles, when you all make heaps of money, you are going to feel like treating yourself by buying yourself a nice new car. I see it every day. Be aware that if the motor vehicle costs more than $57,466, the GST that you claim will be 1/11 of that, which is $5,224, and your depreciation will be limited to $57,466. So if you were thinking of that nice $150,000 Maserati, was going to save you heaps of tax, think again. Should you really be thinking about $150,000 Maserati, come and see me first. Advertising, entertainment, or staff amenities. Now, I'm assuming in this particular case that you're operating a trust, a corporate trust, with a corporate trustee. Entertainment expenses are minefield. If you operate a trust, you are effectively an employee of your business, and as such, the fringe benefits tax rules can apply. Let's focus on what they call meal entertainment. Meal entertainment is entertainment by way of food or drink, or accommodation or travel to do with providing entertainment by way of food or drink. Generally, the rules are if meal entertainment is provided to a client, contractor, or a supplier, it's not tax deductible and is not subject to fringe benefits tax. If meal entertainment is provided to an employee or their associate, so if you have your own trust, you're an employee, your spouse is an associate, unless they work in the business, well then that is deductible but subject to fringe benefits tax. Now generally we try to cap our clients' tax rate at about 30%, which works well if people are disciplined. But what's the point of getting a deduction that saves you 30% if you just got to pay the taxman 47%? That's just stupid. But there are ways to get around that. Meal entertainment is very complex and there's all sorts of different variables. In order to get the best results, it comes down to keeping proper record keeping, splitting your costs in certain ways. Under those circumstances, it's best to have a chat with your accountant to find out what options are available. I work on some simple rules, and this can pretty much apply for what you do every day. Let's say you're a client and I take you to a coffee shop for a cappuccino. That's not meal entertainment and it's deductible. Let's say we go to the coffee shop, I buy you a cappuccino and a piece of cake. As far as I'm concerned, that's not meal entertainment, it's deductible. Let's swap that piece of cake for a sandwich or a pie, call it a meal. It's meal entertainment. It can be that pedantic. Let's look at it another way. If you come to see me and we open up a bottle of wine and we drink it together, it's hypothetical, usually be a few bottles of wine. That's entertainment. Now let's say you come in to see me and I say to you, you've been such a great client this year, I'm giving you this bottle of wine. That's a gift, it's tax deductible. You then say, hey John, I've got this bottle of wine. Let's drink it together. Not a problem. Home office expenses. My understanding is you may be effectively running your business from home. If that is the case, then you would be entitled to claim a percentage of your running costs and your occupancy costs on your home. This percentage is determined based on a percentage of the floor space of your home office divided into the total floor space. I know this stuff is boring, but I have to be pedantic because the tax office is. Your home office needs to be a separate room and must be exclusively used for that business only. The dining area of an L-shaped lounge will not suffice, and the kids can't use the room for their homework. How the tax office is going to pick up on that, who knows? You cannot say that you use your lounge and dining room exclusively for client presentations. Running costs including electricity, gas, cleaning costs, leasing charges and depreciation on work equipment such as computers and repairs to furniture in the home office will be deductible. Telephone costs would be based on actual usage and you would need to keep a register of these costs. The tax officers audited some clients and they've required them to provide copies of telephone bills highlighted to indicate which are the business costs to determine the percentage. They will get that pedantic. Cashback for samples. Actually, sorry, I jumped ahead, my apologies. Occupancy costs can include interest on the home loan, rent, house insurance, rates and taxes and security costs. Some accountants out there say if you claim these costs and you're running a business from home, you'll become subject to capital gains tax. That's garbage. If you are running a business from home, you are subject to capital gains tax. And you'll be subject to capital gains tax on that percentage of the home that you run the business from, and for the period of time that you ran the business from there. So if that's the case, claim the bloody deductions. Cashback for samples. We're aware that some of you will provide cashback incentives for people down the line or to potential customers. I believe a sale is made and you are effectively giving a discount on the purchase, just not a direct discount. And it is genuinely a cost that you're incurring in your business. But the real problem here is proof. There's no way of proving that the cash incentive actually went to who you said it did. The person you gave the cash to does not give you a tax invoice, and so you cannot claim the GST. The person did not give you a receipt or invoice, so you cannot claim the deduction without evidence. In the absence of no other evidence, we recommend that you maintain a diary and you record in this diary when you pay the cash back and to whom. We recommend that this is cross-referenced to the invoice for the sale, evidencing that the acquisition was made by that person. Ideally, getting the person to sign on the document would be even better. Either way, this is a suggestion, it's not foolproof. Dare I say, I had the good fortune of having 2 taxation lawyers take me for lunch the other day. At that lunch, I discussed this matter in detail with them and they said exactly what I said. It comes down to evidence, and then you are pushing it uphill, if I can put it that way. Pretty good result all the same, as I got a free lunch and over $1,000 worth of advice for free. What you should get out of this is the importance of record keeping. Unlike murder, the onus of proof is on you, and you are effectively guilty until proven innocent. Although the rules are a little more complicated, you should assume that you should keep receipts and invoices for 5 years. For simple tax returns in simple business entities, the tax office can go back 2 years from date of assessment to audit you. For other situations, it's 4 years. Don't muck around, assume it's 4 years. And if there's been tax avoidance, or they believe that there's been tax avoidance, they can go back as far as they want. Yep, that one, sorry. Next. That's it. Right. If you manage your tax affairs carefully, you won't come unstuck. But the biggest problem I see is that as income increases, spending increases also. So I refer you to 3 cliches. If you fail to plan, you plan to fail. Time is money, and stash your nuts for the winter. Don't spend money just to get a tax deduction. If you spend $100, you may get $30 back from the taxman. It still costs you $70. Lodge your tax forms on time. Pay your tax on time, but no earlier than you have to. Don't attract attention from the taxman. Get your tax done early, so if you've got a refund coming, you get it sooner. If you've got a bill, you can hold off the lodgement and defer payment. If you have a mortgage on your family home, set up a mortgage offset account. Accumulate your money in this account. That way you're effectively